Real estate investment presentation. Lender inducements for early loan repayment. Get ready because we're raising the stakes with real estate. Lender inducements for early loan repayment. Imagine a situation where we have the standard fixed rate loan, which is typically good because it lowers the risk to us as the changes happen in market rates if we have our rate to be fixed. However, as we do have that fixed rate, we know that the market rates will fluctuate. Is there anything that we can do as the market rates fluctuates to better our position? If we have the fixed rate loan and the market rate goes down, then that means that our fixed rate would be higher than the market rate. That's not good when we're the borrower, and we then could consider whether or not we want to refinance the loan at that point in time, possibly then taking advantage of the lower rate. However, if the rate goes up over time and we have the fixed rate, that's why we've got it to be a fixed rate in order to safeguard against that event happening, because that will result in our payments being stable, the rate being fixed, even though the market rate has now gone up. And if we were to have a variable rate, we would have been subject to that higher rate. Now, in that instance, then, we're in a favorable position. We don't typically want to refinance our loan at that point because the refinance is typically there to take advantage of the lower rates. But the lender then is in a position where they're not in as good a place, because now if they had the money back, they could theoretically loan it out at the market rate, the higher rate, and we're paying back the interest at the fixed rate on the loan. So that means that we actually are in a better position, of course, as rates go up if our loan is fixed. And the lender might end up to be in a situation where they're saying, hey, could we give you some kind of inducements, possibly to give a prepayment on your loan so we can get the money back sooner so that we can loan it back out, making the market rate, which is currently higher than the rate that is on the loan. So after a period of rising interest rates, the borrower may have a loan that has an interest rate that is below the market rate. So you're going to say you got the rate fixed. That's good. The interest rates went up. That's great because now you're paying the fixed rate. You're paying back the loan to the lender with dollars, which are basically worth less than they were before because we're assuming inflation basically happened. And again, the lender, if they were lending out the money at this point, could lend it out and get a higher rate of return, a higher, in essence, rent on the money, a higher rate, a higher interest rate. So a lender may offer a financial inducement to a borrower to prepay the mortgage. So they might say, hey, look, we would like you to pay off the mortgage sooner in that event. If we can get the cash back sooner in that case, that would be good for us because we can then take that money and we can lend it out at the higher rate. And for us, the borrower, who are sitting in a good position at this point in time, we'd say, hey, I'm not really inclined to be paying it off sooner at this point because I'm borrowing at a rate that's lower than the market rate. So it might be a situation where the bank then, or the lender would say, would we give you some type of inducement, possibly some kind of benefit, discount or something like that, in order to induce you to pay back sooner so that we can make back that money by getting the money back and loaning it back out at the higher rate. So the lender could then relend the money to someone else at the higher rate. That's the general idea. So once again, if you got the fixed rate, whether the rate goes up or down in the market, there might be some action that you can take to better improve your situation. Obviously, if the rate goes down and you have your fixed rate, then you might want to take advantage of the lower rate by refinancing. If the rate goes up substantially and you have a fixed rate, then your lender might have a situation where they're saying, hey, we'd like to possibly give you some kind of benefit in order to give us the loan back or prepay some of the loan in that instance as well, and that could be beneficial for both parties too. So the market value of a loan. So in order to consider that in more detail, you'd want to say, okay, well, what would the value of this loan be if the lender was, say, to sell the loan? So for example, if the lender was to sell the loan, you could think about the loan, your repayments on the loan, as in essence a series of payments, kind of an annuity type of calculation. You're looking at it in terms of a cash flow. What would that cash flow be worth at the current market's conditions? So one question to consider is, how much would the investor pay for the loan? So if the bank basically had the loan, that series of payments, how much in essence could they sell that stream of payments for, that annuity in essence? To answer this question, we can think of the cash flow stream of the loan. So meaning the loan is really the commitment that we have is to repay a stream of payments over so many years that are currently left in the loan. If it's a fixed term and rate loan, it's a fixed amount, fixed payment, fixed periods, and so on. Discounting the cash flow at the market rate of interest that the investor can earn on investment of equivalent risk. So now we can discount that, in essence, present value that stream of payments, not at the interest rate, but at the discount rate. So we can look at the current value of that stream of payments given the current discount rate. So we'll do a practice problem on this so you can get an idea of it. But if you're the borrower, you can kind of get an idea of what the benefit would be to the bank then if you were to give the prepayment, the early payments back, so that you can then have a negotiating position if they were in a position where they wanted to give you some kind of incentive in order to help get the prepayments sooner, which could be beneficial to both sides. So this is going to be our problem here. Again, we'll work this in more detail in a practice problem in Excel and in OneNote. But just to get an idea here, let's imagine we had the loan, 30-year loan, 360 months, 30 times 12. The rate is at 6%. And then after a year, we're going to say that the rate went up to 7%. So we locked in the 6% on the loan, which was a good thing because now the market rate is 7%. That means that our payments calculated using the rate of 6%, the loan amount, is $599.55, about 600, and then 1 year later the market rate went up to 7%. Here's the total payments on the loan and the interest. So then we can say, okay, well, here's our amortization table on down below. We had the loan amount here that was calculated. We had the $600 payments, which are standard throughout the loan. We have the interest. The interest is calculated based on this 6% rate up top. And that's how we're going to amortize this table. It will then be fully amortized after the 360 payments after the 30 years. After 1 year, this is where we're at after 12 payments in 1 year, we're at the 98,772. Imagining that year has now passed and the market rate is now up to 7%. So now that, again, we're in the good spot. We're saying, okay, now I'm paying back my loan and I'm only renting the money at 6%. And I locked that in so they can't change it on me. And the market rate is now at 7%. So if I had a flexible rate, it might have flexed up to something like 7%, but we locked it in basically at the 6%. So we're looking good. We're not going to refinance at that point in time. But the bank is saying, man, if I had that money back at this time, I could be lending it back out at the 7%. So we can kind of get an idea of what that would look like. We could say, well, this is how much we owe right now. We owe 98,772. If we were to give that back to the bank right now, the 98,771.99 about that we owe back, they could take that money and then loan it back out at the 7%. What we're going to do is we're scheduled to pay that back, that 98,772 back, but not for 29 years. We're going to pay it back in 29 years plus interest at the 6%. So we can then say, okay, well, what's my series of payments here? I'm paying around $600 for the 29 years left on monthly payment cycles. If I look at that series of payments and discount it back at the market rate of 7%, we can get what the present value is, in essence, of that series of payments. So you could do that a couple different ways. You could use a present value calculation. So if we present value the rate being the 7% divided by 12, I won't go into this in detail because we'll do it in Excel and in OneNote. But then we could say, comma, the number of periods is 29 years times 12 for the months. And then, comma, the payment amount is going to be the $600. So in other words, we're looking at the present value of that series of payments of that annuity, not at the 6%, but the market rate of the 7%. That would give us the 89,201.56. That's the market value, in essence, of the stream of payments that we would have. So in other words, if the bank was able to get the money back now in today's dollars, it would be worth the 98,772. And if we discount the stream of payments that we are scheduled to make at the current discount rate of 7%, it's only worth 89,201.56. So we're scheduled to make a stream of payments, in other words, that are currently valued on a present value of 89,201.56, but we owe in present value terms, if we had to pay it back today, of 98,771.99. Therefore, if the bank was able to get us to pay the entire amount today, the 98,771.99, and able to then loan it back out at the 7%, you could see they're basically making 9,570 in essence in terms of present value terms, right? Because the book value of the loan right now is the 98. If they can get that money back today, that would be in present value terms. Discounting the series of payments that we're making means that at the current rate means that that series of payments is only worth 89,201.56. So if we paid back the whole loan amount now, they would basically kind of be making in present value terms 9,570. So based on that information, any kind of prepayment that we get back to them sooner, that they can turn around and reloan out sooner, could be a beneficial. So once we know kind of what that is, the bank might try, different options to incentivize us possibly to pay back the loan sooner. Maybe not the full amount, but they might try to get, money sooner from us on the loan and possibly give us some incentive to do that. If we have an idea of the benefit to them, then we might be able to negotiate that process with them and get, the best terms we can and possibly benefit in ourselves even during increasing rates by working with the bank in that instance. We'll also work through this with a cash flow on an IRR calculation, which sometimes it's more intuitive, although it's a little bit longer, meaning you can kind of prove that this is true by saying, if I took this 89,201.56 as like the outflow, and then I was going to receive the payments that we were going to be paying, our stream of payments with the 600, if I was to present value this stream of payments, meaning I'm going to pay for this annuity payment, 89,202 upfront in period 0, in order to receive $600 for the remaining 29 years each month on a monthly basis, then that would discount, or the IRR calculation, the rate at which that stream of payments would be 0, would be then the 7%, which would kind of prove, our calculation up top. So that's going to be the general idea of it. And so remember that if you have the fixed rate, then the market rate, of course, will fluctuate. The bottom line is, if the market rate goes down substantially, then you could benefit from refinancing. If the market rate goes up substantially, then you possibly could still benefit by negotiating with the bank and seeing if you can come up with mutually beneficial terms by prepaying possibly, and getting some kind of inducement possibly to do so, if that's something the bank would be willing to do.